Hey everyone, and welcome to the investing channel where we separate hype from reality. Today, we're diving deep into the hottest trend in the market, active ETFs. These newcomers promise the magic touch of stock pickers wrapped in the convenience of your favorite ETF. But is it all sunshine and rainbows, or are there storm clouds lurking beneath the surface? We'll be pulling back the curtain on the hype versus reality of active ETFs. We'll explore the allure, the challenges, and the potential pitfalls these shiny new vehicles might hold. Buckle up, because we're about to take a wild ride through the ETF landscape and expose the truth about whether stock pickers can truly shine in this new arena. The exchange-traded fund, ETF, landscape is witnessing a new wave of players, active stock pickers. For decades, ETFs have been synonymous with passive indexing, providing broad market exposure at low cost. Now, veteran stock pickers, with their track records of beating the market, are launching actively managed ETFs, hoping to replicate their success and capture a slice of the burgeoning ETF market. But will these star fund managers shine as brightly in the ETF wrapper as they have in the traditional mutual fund realm? The answer is not as straightforward as it might seem. The allure of active ETFs. The attraction of active ETFs is undeniable. Investors get the benefits of active management, potentially superior returns through skilled stock selection, wrapped in the advantages of ETFs, transparency, tax efficiency, and intraday liquidity. This combination is particularly appealing to a new generation of investors who are accustomed to individualized experiences and demand more control over their portfolios. For active managers, ETFs offer a compelling avenue for growth. They provide access to a broader investor base compared to traditional mutual funds, which often have high minimum investment requirements and limited distribution channels. Additionally, the lower expense ratios of ETFs can potentially attract fee-conscious investors. Challenges for active stars in the ETF universe. However, translating past success in mutual funds to ETF glory is not guaranteed. Several hurdles could dim the shine of even the most celebrated stock pickers. 1. The indexing headwind. The market's relentless march towards indexing presents a formidable challenge. The Morningstar's U.S. active/passive barometer paints a stark picture. Over the past decade, only 10.5% of actively managed U.S. large-cap equity funds outperformed their average passive rival. This reality casts a long shadow over active ETFs, making it difficult for them to consistently deliver alpha, the excess return over the market benchmark. 2. Performance pressure and fees. ETF investors, accustomed to the transparency and daily performance fluctuations of the underlying assets, often scrutinize returns much more closely than mutual fund investors. This increased pressure can lead to short-termism and a temptation to chase hot stocks, potentially jeopardizing long-term investment goals. Additionally, while ETF expense ratios are generally lower than those of mutual funds, they are not immune to fee creep. If an active ETF underperforms, the higher operating costs compared to passive vehicles can further erode returns. 3. The transparency paradox. One of the key selling points of ETFs is their transparency. Unlike the closed-door nature of some mutual funds, ETFs disclose their holdings daily. This can be a double-edged sword for active managers. While transparency fosters trust, it also allows competitors and front-running traders to mimic their investment decisions, potentially diminishing the alpha-generating potential of their stock picks. 4. Structural differences. While ETFs and mutual funds may share similar investment objectives, their structures differ significantly. Mutual funds offer daily redemptions, which can force active managers to hold a portion of their assets in cash to meet withdrawal requests. This limits their ability to fully deploy their capital and capitalize on market opportunities. ETFs, on the other hand, trade on exchanges, eliminating the redemption pressure and allowing for more dynamic portfolio management. However, this advantage comes with its own risks. ETF shares can trade at premiums or discounts to their net asset value, NAV, introducing another layer of volatility for investors. 5. The active ETF ecosystem. The active ETF ecosystem is still in its early stages. The infrastructure, including research, analysis, and portfolio construction tools, is not as mature as for passive ETFs. This can pose challenges for new entrants, requiring them to invest heavily in building robust systems and processes to support their active strategies effectively. A glimmer of hope. Despite the challenges, there are reasons to believe that some active ETFs can succeed. Managers with long-term track records, clearly defined investment philosophies, and a commitment to cost efficiency could stand out from the crowd. Additionally, niche sectors or strategies, where passive indexing is less effective, may offer fertile ground for active ETFs to generate alpha. Navigating the active ETF landscape. For investors considering active ETFs, due diligence is paramount. Scrutinize the manager's track record, investment process, fee structure, and portfolio holdings. Understand the specific risks associated with the chosen strategy and the ETF structure. Remember, even star stock pickers can have off years, and past performance is not a guarantee of future results. Conclusion. Active ETFs hold both promise and perils. While they offer a novel way to access skilled stock selection, overcoming the headwinds of indexing, managing performance pressure, and navigating the unique challenges of the ETF ecosystem are critical hurdles. Investors should approach active ETFs with cautious optimism, carefully evaluating their suitability within their overall portfolio strategy. The jury is still out on whether star stock pickers will shine as brightly in the ETF arena as they have in the mutual fund realm. Only time and the market's verdict will tell if they can defy the odds and carve out a sustainable niche in the ever-evolving world of exchange-traded funds. Additional considerations. The role of technology. The rise of big data and artificial intelligence could potentially provide active managers with new tools to uncover hidden alpha opportunities and refine their stock selection process. However, concerns about technological arms races and the potential for AI-driven manipulation of markets should be acknowledged. The regulatory landscape. Regulatory changes, such as those proposed by the SEC regarding actively managed ETFs, could impact the structure and fees of these vehicles. Investors should stay informed about regulatory developments and their potential implications for active ETFs. The future of indexing. The indexing revolution is unlikely to abate anytime soon. However, passive management itself is evolving, with the emergence of smart beta and factor-based indexing strategies offering investors more nuanced exposure to market segments. This could further squeeze the alpha-generating potential of traditional active strategies, both in mutual funds and ETFs. In closing, the arrival of active ETFs marks a new chapter in the ongoing debate between active and passive management. While the challenges are significant, active ETFs offer intriguing possibilities for investors seeking potentially superior returns within the familiar wrapper of an exchange-traded fund. With careful research and a dose of healthy skepticism, investors can navigate the active ETF landscape and explore whether these star stock pickers can truly shine under the bright lights of the market. So, there you have it, folks. The truth about active ETFs, a mix of promise and peril. The jury's still out on whether they'll deliver on the hype. But before you jump on the bandwagon, remember this: do your due diligence. Scrutinize the manager, the fees, the strategy, and understand the risks. This ain't your grandma's passive ETF, so approach it with cautious optimism and a healthy dose of skepticism. If you're looking for potentially higher returns and control over your portfolio, active ETFs might be worth exploring. But remember, the market is a fickle beast, and even the brightest stars can fade. Invest wisely, folks, and never forget the golden rule: there's no free lunch in this game. Hit that like button, subscribe for more investing insights, and let me know in the comments below, are you bullish on active ETFs, or are you sticking to the passive path? The debate is on.